Hello, I'm Joel, and welcome to the first episode of Stock Talks with Joel. The following is a collection of my thoughts and should not be interpreted as investment advice. I hope you find it useful. In this episode, I want to look at 10 reasons why you should be raising cash in your portfolio between now and the end of the year. Reason number 10. COVID has accelerated the pace of disruption in the economy. This creates both winners and losers, but some companies will go to zero, so you need to pay attention to your investments. For example, Zoom has drastically reduced the profitable corporate travel market, which hurts the airline and hotel companies. Traditional ICE vehicle manufacturers are carrying a $1 trillion debt burden and are too slow to adopt to the rapidly changing consumer demand for EVs and autonomous driving. All the while, Amazon and other online retailers continue to destroy traditional retail. You need to make sure that you are invested on the right side of this trend, and owning an index fund just isn't the answer. Reason number 9. Asymmetric risk in the bond market. Government bonds have traditionally been thought of as risk-free return, but now they more aptly represent return-free risk. Almost all of the over $250 trillion of global fixed income securities trade at a negative real yield based on current yields and inflation levels. For example, the U.S. high yield index yields 4.64%, but the CPI is currently running at 6.2%. This is crushing savers' purchasing power and is likely impacting consumer spending. These negative real yields are distorting markets from real estate to stocks and have caused a bubble in NFTs and altcoins. These negative real yields are being driven by non-economic bond buyers who may start to act more rationally when it comes to real interest rates once we emerge from the COVID crisis, sending yields significantly higher. I think we're likely to see at least 3 to 5% on the 10-year Treasury, which would raise consumer borrowing costs into the high single digits. Reason number 8. Troubles in Chinese real estate pressure real growth while risking a financial crisis. China's savings rate is one of the highest in the world, but limited local capital markets and capital restrictions have left the average Chinese saver with very few investment options. This has forced them into investment properties in the local residential real estate market. Residential real estate investments represent the majority of the savings of the average Chinese citizen. This excess demand for housing has led to massive overbuilding, driving the official national vacancy rate above 21%. The issues of ghost cities and suspended projects have been talked about by Western investors and journalists for years, but with the world's largest developer, China Evergrande, on the verge of defaulting on its debt, these issues are being brought to the fore. Residential real estate accounts for 29% of China's economic activity, much higher than the 10 to 20% for most other developed nations. If the Chinese government does not step in, there's a very real risk of a financial crisis in China. State involvement in the financial system has prevented market forces from exposing waste, corruption, and unprofitable projects in the same way that a free market banking system does. China will likely have the tools and ability to weather this storm better than the U.S. weathered the 2008 financial crisis, but it would still require a painful process which will decrease domestic demand and put downward pressure on commodities. Reason number 7, supply chain bottlenecks. COVID lockdowns, clogged ports, container shortages, blocked shipping channels, and labor and trucking shortages have been rippling across the globe, causing backups, delays, and shortages all throughout the global supply chain. This has exposed a weakness in the just-in-time inventory system, which has become common in most countries, forcing companies to rethink their supply chains. These issues are lasting far longer than most had expected and are continuing to drive costs higher and real output lower. Reason number 6, inflation is causing cost pressures and reducing demand. Recent CPI figures have remained persistently high, coming in at 6.2% year over year in October, 0.9% month over month seasonally adjusted. This is the highest inflation that the U.S. has seen in over 30 years. Consumers are reacting to higher prices by delaying certain purchases, hoping that global supply chain issues can be worked through and prices will return to more normal levels. Whether this will be the case or not remains to be seen, but in the meantime, this is causing a decrease in demand, as was seen in the weak Q3 GDP growth of just 2%, compared to 6.7% growth in Q2, and well below economists' expectations of 2.8% growth. Reason number 5. Fiscal policy is turning from extremely stimulative to more restrictive. Governments around the world took on record amounts of debt to deal with the economic fallout from the pandemic. As interest rates rebound, the cost of carrying this debt will rise, and governments are likely to face pressure to reduce deficits. This will probably lead to higher taxes and lower spending going forward, which in turn will leave consumers with less money to spend and leave investors and businesses with less money to invest, lowering both earnings and earnings multiples, ultimately leading to lower stock prices. Reason number 4. Valuations are extended relative to historical norms. We're approaching valuation metrics only ever seen at the height of the dot-com bubble. The S&P 500 currently trades at 29 times trailing earnings, 4.7 times book value, and has a 1.3% dividend yield. At the peak of the dot-com bubble in March of 2000, these statistics were pretty close, with the S&P trading for 28 times earnings, 5 times book value, and having a 1.1% dividend yield. Lower interest rates and high profit growth rates do help to justify these high valuations, but there's not much higher to go and a lot of room to fall when compared to historical valuation ranges. We can certainly exceed the dot-com peak in valuation metrics, but this would just set us up for an even more significant decline when the bull market finally ends. Reason number 3. Increased presence of passive investors in the market pushes valuations higher, but also reduces the brakes on the way down. Mutual fund managers generally hold a few percent of their net assets in cash to meet redemptions and take advantage of opportunities provided by future price declines. Passive investment funds, on the other hand, are fully invested at all times. In fact, many have negative working capital due to accrued expenses owing to their fund managers. The share of passive mutual funds and ETFs has risen from less than 2% of the industry in 1995 to more than 40% of the industry in 2020. This has pushed down the aggregate cash levels at funds. In addition to this, many large institutions now employ benchmark tracking for a large portion of their portfolio, further increasing the total assets, which are on autopilot. Then you add in that many short-biased hedge funds have either shrunk assets significantly or gone out of business entirely in the past 10 years, and Reddit short attacks on meme stocks like GameStop and AMC, keeping hedge funds gun-shy with their short bets. All this put together means that another significant source of dry powder, being short covering, has shrunk significantly in recent years. Which begs the question, when most investors are relying on the wisdom of the crowd to blindly following a broad market index, who is there to make sure that stock prices aren't overvalued? The answer is no one, really. If and when investors realize that prices are overvalued and try to redeem these passive funds at the same time, there will be very few buyers left to cushion the fall, and we risk a black swan type decline of 20 to 50% in the stock market over a short period of time. To help put this into perspective, a 50% decline would just bring us back down to historical average valuation metrics. You'll definitely want cash on hand if this transpires. Reason number 2, loss of the Fed put, at least for now. The Fed has a dual mandate of maximum employment and price stability. The recent CPI figures have remained persistently high, as discussed earlier. The 6.2% year-over-year inflation figure is the highest in over 30 years and is clearly not consistent with price stability in the context of the Fed's 2% inflation target. On the employment side, the unemployment rate has fallen from a record 14.8% at the height of the pandemic in April 2020 to 4.6% in October 2021. While this is slightly higher than the 3.5% seen before the pandemic began, we are on a path to full employment, and the Fed's work on pandemic recovery is largely complete. This has caused the Fed to begin tapering its bond buying, with the buying expected to cease completely by June of 2022. The more hawkish members of the Fed are likely to dissent against altering this course of tapering unless inflation data and stocks are significantly lower, financial conditions have tightened significantly, and spreads have blown out. And the number one reason that you should be holding more cash is, drumroll please, the Omicron variant. Spike proteins are the keys which allow certain viruses to enter and infect cells. It is the spike proteins that sticks out of the virus, as well as any infected cells, and our immune system uses sections of this key to identify the viruses and infected cells and fight back. There are 32 mutations around the spike protein of Omicron compared to the original COVID-19 strain. This is significantly more mutated than in Delta. There are clusters of mutations in two key areas. Number one, the receptor binding domain, which controls how well the key works at getting in, and two, the antigenic supersite, which acts as a target for our body's defenses. The vaccine manufacturers are coming out and saying that current vaccines and treatments are likely to be less effective against Omicron. The abundance of mutations in these key areas, combined with a rapid increase in cases in South Africa over just the past week, leads me to believe that Omicron is likely able to avoid a significant portion of the immunity from existing vaccines and or prior infections. The good news is that there have also been reports that Omicron causes less severe symptoms and disease than Delta. If true, COVID-19 is well on its way to becoming another strain of the common cold. We definitely need more data before we can know for sure what the impact of these mutations will be, how effective the vaccines and prior infections are, and whether it leads to more or less severe disease. But as investors, we need to try to price in the currently available information and think about what is likely to occur in the future, and that's what I'm trying to do here. We are probably about 100 days away from having vaccines approved for Omicron, but it will take probably a year until we can get the majority of the world population vaccinated. So vaccines won't come in time for most people, although the most vulnerable populations in the developed world should get protection in the first half of 2022. Lockdown fatigue is real, and governments will likely struggle to get their populations to respect future restrictions, such as mask mandates and social distancing. This leads to the potential for a super spike in global cases, much greater than the prior peaks. Especially if symptoms are mild, younger populations will have almost no fear of catching the virus and will spread it and catch it readily. The good news is that this may be the final wave, where the entire planet gets immunity at the same time from either vaccines or infections-reinfections, which may have the positive side effect of ending the pandemic. Although new, less deadly variants are likely to continue to live on as another strain of the common cold, we may be able to end our pandemic-era responses, such as masks and social distancing. If nothing else, the Omicron variant introduces uncertainty, and investors hate uncertainty. Omicron is likely to delay the reopening of the global economy and hurt the reopening stocks. Fiscal and monetary responses are likely to be more muted to this variant than in the past, so the economic shock of lockdowns, both voluntary and mandated if they're actually required, could be much worse than in previous rounds. So what do? Do you run out and sell all your stocks because the world is ending? No, absolutely not. I still believe that a portfolio of stocks and cryptocurrencies, with some real estate, especially outside bubble markets like Canada, Australia, and New Zealand, will provide the best path to wealth creation in the future. I'm only advocating that you raise your cash level above your targeted level and be prepared to buy companies who are going to withstand the upcoming storm and come out the other side even stronger. There are also a number of tailwinds for stocks, which is why you should get ready to buy high-quality companies into the decline. Number one, the Santa Claus rally is still possible, as Omicron's spread will take time to play out and investors have variant fatigue, so the market reaction to Omicron will definitely take some time to fully play out. Real short-term interest rates are still extremely negative, so even though on the margin the Fed is tightening, their policy is still quite loose and accommodative by historical standards. Number three, bond yields currently provide little competition to stocks. Investors are likely to increase allocations to equities and crypto and decrease allocations to bonds over time. Stocks have also been historically a very good inflation hedge, as most companies are able to ultimately pass on higher costs to consumers. Advancements in and deployments of robotics and AI will also lead to increased productivity and corporate margins for the companies which adopt quickly to changing technologies. Negative real yields and resilient economic growth could lead to an M&A boom, pushing valuations to all-time highs. And there's still a lot of unspent stimulus funds out there which have been committed or are about to be committed, think Build Back Better plan, which have not yet been spent. This should help support the economy through the next few quarters. The real conclusion here is that the risk reward in the stock market has shifted, and I recommend holding above average cash levels for the foreseeable future. The right cash level for you will depend on your age and financial situation. You should consult a financial advisor if you need help with this. Thanks for listening.